The other thing that I was reading is that apparently consolidation has increased amongst banks, and I think that's mostly due to the regulatory requirements. Banks are required to have so much capital on hand that it's just hard for smaller banks to survive in this regulatory kind of environment. The other piece of news that I saw today about small banks is there's this guy. Oh, what was his name? He used to work for Warren Buffett, and he kind of left under a haze of like something fishy happened with their stock trading.
I know what you're talking about. His name escapes me as well at the moment, but yeah, it was a couple years ago.
Well, he is actually out in Virginia now, and he owns a controlling, well, maybe not a controlling interest. He owns a huge interest in Middleburg Bank, which is a local bank. And he is pushing to get them bought by someone else because he says that anyone under $2 billion can't survive. And I think to the average person, you hear $2 billion and you're like, whoa, it's a lot of money. But in banking, it's really nothing.
No, when you're dealing with balance sheets that have trillion-dollar asset bases in a JP Morgan or Bank of America, I mean, $2 billion is a rounding error for them, right? And kind of on the consolidation in those banks, big banks becoming bigger, that scares some people, and there are obvious downsides to that. It's very hard to understand everything that's going on in banks as they consolidate and get bigger. And I know you and Jay talked about that last week too. I think you mentioned Citigroup. You were like, I look at Citigroup's 10K and it's like, what in God's name is this business and what's going on in here? But I think there is a benefit to that as well, that the perceived complexity or the actual complexity of these big banks may artificially depress the valuations that they're getting as well. And maybe that's always going to be an overhang. But I think if you take the other side of that, it may be a benefit that you're saying like, all right, there's this bank out here that has a lot of earnings power, Citigroup, JP Morgan, Bank of America. They have the potential to generate returns on equity over 10%. But because they're so complex in the short run and people don't kind of fully understand where all of that's coming from, you can pay less for it. So I think there is a balance there of like, okay, you have the complexity of Citigroup, but you're getting a discount because of that complexity, as opposed to a small bank that you may look at and say, oh, I understand exactly what they do. They're only in West Virginia doing this type of loan. And that lack of complexity, you're going to probably have to pay more for that on the valuation side. So
right. And
I don't fully say complex bank bad, never buy it. I think you're always paying for it regardless, whether there's a lot of complexity or not.
Yeah, and as we've been seeing with the oil patch banks, that lack of diversity can really hurt a bank in the long term,
right,
if things go sour for them.